Hey guys, in this video I'm going to look at ServiceNow stock and try and figure out whether it's a good time to buy or not. I'm going to use discounted cash flow techniques and financial statement analysis and just see if it's a good value. If you're new to the channel, my name is Dan. I do a lot of stock analysis here, so if you like that kind of thing, hit the subscribe button to check out more videos like this one. Alright guys, let's get started. Alright guys, so this is ServiceNow. They are a software company. They provide software solutions for businesses. You see here they have IT workflows, employee workflows, and customer workflows. These are all pieces of software that really help businesses manage their customers, employees, and their IT work as well. So the way ServiceNow generates their revenue is very simple. They lump most of their revenue into one category called digital workflow products, but 14% comes from another category called IT OEM products. That stands for IT operations management, and they describe that as products that connect customers' physical and cloud-based IT infrastructure with their applications and their platform. They generate revenues from all over, but you can see a little concentration in North America sales there, coming in at 66%. Asia Pacific is 9%, and the rest is from Europe, Middle East, and Africa combined. Okay, so here's a quick look at ServiceNow stock. It has done quite well over the past year, going up at about 75%. The company is currently valued at $115 billion, giving it a forward PE ratio of 108. So with the stock selling for 108 times what they're going to earn next year, we're going to need to see some pretty serious growth expectations to make this a good deal. ServiceNow does have pretty incredible growth going on. You can see about 10 years ago they had revenues of $128 million. Today it's about $4.5 billion. Now, even though the revenues have been growing, they've actually been losing money for years. As you can see here in the red, their operating profit margin has been negative every year until December of 2019 when they eked out a small profit there. And last year they managed to increase that margin to 4.5%. So they're really changing the stage of the business cycle here from a young startup to a growth company, and it's a very exciting time. Here is a vertical analysis where I've taken all of their income statements and divided every number by revenues in that year. So what I see here is that their cost of revenues is very low, and that has been consistent and trending downward, may I mention, probably as they gain economies of scale, meaning their gross profit margins are increasing and very high even for this industry here at 78%. So I really like to see that. Of course, most of where their expenses go is selling, general and administrative expenses and R&D expenses. So you can see, for example, SG&A expense accounted for about 51% of their revenues last year. That is high, but I would note again that you have a lot of fixed costs here, meaning that as your revenues grow, this will go down as a percentage of revenue as it has been. Okay, so what we have here is the net income margins here at the bottom. And again, they've just turned profitable here. I would not pay too much mind to this 18.1% net income margin in 2019. That was caused by an unusual item here. Income tax expense was negative. Now, why was it negative? Well, remember, they had been losing money for years. So in the first year they make money, they're given a tax credit by the IRS, essentially. It's called net operating loss carry forward. It results in income tax refunds. But essentially the idea here is that you should not expect them to have 18.1% margins right away. I think 2.6 is more where we're at right now. Okay, so here is their balance sheet. Like a lot of young companies in the software or tech space, they're going to have a low debt to assets ratio, Lenders generally don't like to make loans to companies that don't have physical collateral to back up those loans. You loan someone a bunch of money to do some R&D. Maybe they just don't find anything. And it's like, oops, can't pay you anything. So again, that's very typical. But I do like to see that. I like to see the low debt ratio there. Current ratio is just fine, 1.2. Again, a little bit higher is always nicer, but the important thing is that it is above 1. And if you don't know about any of these ratios, check them out in the description below. They do have quite a bit of cash on their balance sheet as well. So they could in fact take a lot of this cash and pay down that debt whenever they feel like it. Interest coverage ratio is just 6.27. So their interest expense right now is eating up quite a bit of their profit. But again, they are growing. They barely made any money last year. So I don't think that's going to be their coverage ratio going forward as they increase their earnings. So overall, a pretty good balance sheet. Okay guys, at this point in the video, I'm going to use an intrinsic valuation model to value ServiceNow. I'm going to use the free cash flow to equity model. Now, in this model, there are many assumptions. We have to come up with those free cash flows to equity, and there's a lot of assumptions in there. So what I want to do first is really just look at what the revenue is going to be in the future. For that, I'm going to use analyst forecast data. And after that, I have to assume some kind of profit margin and some kind of reinvestment rate, and ultimately come up with a stream of free cash flows to equity. Once I do that, it's as simple as calculating the value. The value will be equal to the present value of those free cash flows to equity. Okay, so here you have tons of analysts forecasting for ServiceNow for next year. You got 30 analysts for the next couple of years here. Then you drop down to 8, and then just a couple analysts forecasting after that. It's important to keep that in mind, guys. The further out you go, the fewer analysts are willing to make a forecast. And so because these forecasts are so far out and because there's fewer analysts, they're a lot less reliable. Just have a look at estimated revenue here for 2028. Okay, it's based on 2 analyst opinions, right? One analyst thinks the forecasted revenue will be 18.7 billion. The other thinks it'll be 24.24 billion. Huge difference between those two numbers, and so you got to keep that in mind there. Look at the forecast for the next year. They figure it'll be between 5.48 billion and 5.8 billion. Pretty tight there, pretty close. So anyhow, what I'm going to do is look at these numbers. They are very impressive. Revenue is supposed to be growing at about 25 to 28% here over the next couple of years, really going out until 2024. Afterward, it starts to go down a little bit, but still pretty respectable. I'm going to use these numbers and try and plug them into my model. Okay, so when we calculate the profits the company will generate, we also have to estimate how much they're going to need to reinvest back into the business. For this company, I don't see a whole lot of reinvestment. What I see is mostly R&D, which is an expense. And I see a little bit of money going into acquisitions, though not really a whole lot. They do have some capital expenditures, though, and those are coming in at about $400 million in the most recent year. I'm going to keep that in mind as I estimate reinvestment rates. Okay, so here's kind of a path that I see for ServiceNow. I've taken the revenue growth estimates by the financial analysts and plugged them directly into here. For the years afterward, because it's based on the opinion of just a few analysts, I've taken my own estimates there. I'm going to say about 15.8% for years, 5 through 10 there. But for the next 4 years, they're going to enjoy that very high growth rate in revenues. That gives me a stream of revenues. Now, to get from revenues to actual profits, net income, I need to estimate margins. Now remember, the company earned 2.6% profit margin in the most recent period. I'm going to assume they can improve upon that slowly as they gain economies of scale. Not super slowly. You can see the path I've given them here, topping out at 32% after 10 years. This is, doable for a software company to achieve 32%. They could achieve it sooner or later. I'm just going to go with this path right now. So that gives me net income. After that, I need to reinvest some back into the business. That's where my reinvestments come in. I have given the company a very high reinvestment rate. You saw their reinvestments in the previous section. They spent about $400 million, maybe a little bit more than that if you average out the acquisitions. And so I have that level of reinvestment for the next period. That gives them a reinvestment rate in excess of 100% of what they earned, but that is to be expected for a young company like this. As the reinvestments go up slowly, the reinvestment rate actually goes down because they're going to be generating more and more profit. It won't be as much of what they make as a percentage. But anyhow, guys, that gives us a stream of free cash flows to equity. Let's discount it back to present value and see what the company's worth. So we have a stream of free cash flows to equity. I then discount them back to present value using an 8% discount rate. I get a terminal value by taking the free cash flows to equity in the terminal year, that's year 11, and divide it by the discount rate minus the perpetual growth rate. I'm going to assume they can grow their income perpetually at 2.5% after 10 years. If I do this, I get a total firm value of about $78 billion with these three components here. And that gives me a fair price per share of $403.68. Now, unfortunately, that is far below the share price today, but let's change the assumptions around and see what we can do here. Okay, so with the stock currently selling for over $560 a share and the fair value being about $403, I'm going to revisit the assumptions and see if there's anything we can do to make it a buy. Now, I'm not trying to convince myself, and you shouldn't try and do that when you're looking at stocks either. I'm only trying to see what would make this a good deal. What are other people assuming to be pricing the stock at the level it is? So if we go back to our revenue growth, maybe the revenue growth can keep up that high pace for a while longer. Let's plug in 25% here. So maybe it can keep going like that. That would give us about $44 billion in revenue in 10 years. So if that sounds reasonable to you, let's just see what we can do there, see what happens. Another assumption I could change is maybe the net income margin. Maybe we get to where we're going a little bit faster than I think. So maybe we'll start at 8% the following year and top out at 35% there. So with this path here, let's see what the fair value would be. Okay, so with those modified assumptions, a bit more optimistic on the revenue growth, a little bit more optimistic on the margins there, we're able to get an intrinsic value per share of $638.23, which would make the stock undervalued. One last factor I like to check is insider trading activity. For this company, in the past 3 months, you got 2 insiders buying and 28 selling. That doesn't look too bright right now. Looking at the number of shares involved in these transactions, you can see about, just about 8 times as many shares sold compared to shares bought in the past 3 months. So on the whole, I think it's a slightly negative signal about the future. Okay, guys, so here are my final thoughts on ServiceNow. First thought is hit that like button. I really appreciate it. But seriously, second thought is this. They have a pretty good balance sheet. For a lot of these growth companies, especially companies losing money every year for almost a decade, the balance sheet can get pretty beat up. But for this company, it actually looks pretty good. I don't think they're all that risky in that respect. But they certainly have operational risk. They've just turned the corner. They've just started to make a profit. Things do look good, but it's not a stable, solid business that has a good track record or anything. So I'm gonna need to see a pretty good deal to want to jump in. With this company, when I do the analysis using intrinsic valuation models, I generally find that it's overvalued. I can see a scenario where it is undervalued, but to make that scenario work, I have to plug in, pretty optimistic assumptions in my view. When you start to forecast out growth of over 20% for the next decade, yeah, it can happen. It happened for Google, it happened for Amazon, but I just don't like to throw those kind of numbers around and just to assume a company is going to be super successful. As well, the insider trading activity doesn't bode well for the company. So altogether, I see a lot of signals where, it does seem like the business is here to stay. It does look good going forward, but the stock looks overvalued to me. And so I'm going to pass on it. Let me know what you're going to do in the comments below. I appreciate hearing from you. Thank you guys for watching.